Wealthies, welcome back. If you're new here, this is All the Wealth, our Wealth More wealth building channel. This is a market update from our portfolio strategist, Matthew Levy. As things happen in the market, we bring you timely, relevant market updates.
Hi everyone, I'm Matthew Levy, portfolio strategist for Wealthmore. Glad you're joining me because we've got a lot to talk about. Over the last couple of weeks, markets have given us quite a ride, and it all started with the new tariffs announced by President Trump on April 2nd. You know, these tariffs haven't just impacted the stock market. We've seen significant ripple effects across bond markets and currencies, and as well as the economy, starting to take note. So today, I'm going to walk through kind of what's been happening, why it matters, how it's affecting your investments, with a simple goal just to give you some clarity and context during this little bit of a chaotic period so you can feel more confident, more informed, no matter kind of how wild things get out there. So we're going to jump in with the latest news on just the tariffs for now. Just to recap, April 2nd, President Trump gave us and the global markets quite a shock with a sweeping new round of unexpectedly high tariff announcements. At first glance, they were quite massive. Most notably, tariffs on Chinese imports jumped up to 145%. There's also new tariffs on some of America's closest trading allies like Canada, Mexico, Japan, South Korea, and the EU. This created an immediate fear of a global trade war starting, and markets were sharply lower. Then, of course, just a few days later, Trump partially reversed course on these tariffs, responding to some of that turmoil we were seeing in financial market. There was significant pushback from businesses and even some of his own political allies, and he ended up pausing and scaling back some of the tariffs, especially on the tech industry. Just recently he announced that smartphones, computers, memory chips, and other kind of critical tech products were exempt from these tariffs completely, at least temporarily, which brought relief to companies like Apple and Dell, who import quite a bit of products from abroad. The trick for market forecasters and economists is these reversals, first of all, weren't universal, and the story is far from over. High tariffs remain firmly in place against China, and tensions are pretty high between the world's two largest economies. Also, tariffs on other major allies like the EU, Japan, and North America, they're only temporarily suspended for 90 days. So we have 3 months while they negotiate. As we get closer to the end of that 3 months, we're going to start seeing, if there's no resolution, we'll start seeing more volatility from that date, that arbitrary date being chosen. That being said, markets did get a bit of breathing room, even with that underlying uncertainty. You might be wondering, why does this matter so much? Tariffs are pretty important. They affect the cost of goods you and I buy every day. So if you buy groceries, the avocados you buy at the store might not be grown in the US, probably from Mexico. The clothes you buy from H&M, they might source some of those from China, or Nike shoes that are made in Vietnam. You might want to buy a foreign-made car, or even your electronics like your phone. These tariffs will start to complicate things and make things cost more, which in general can slow down economic growth, disrupt these supply chains that have taken years and decades to change, and impact both big and small businesses. The supply chain thing, if you remember when that Evergreen boat got crashed in the Suez Canal, everything kind of collapsed over time and caused a huge market uncertainty. We're seeing a similar type effect in supply chains if they don't have the certainty they need from the what tariffs are in place and how much. The big takeaway here is that businesses love predictability, and right now there's simply very little of it. And until there's a clear resolution, that's going to be one of the biggest themes in investing for the balance of this year. Now let's talk about what the stock markets have actually done since these tariffs went in place. Immediately following that April 2nd news, we saw way more volatility than some stock markets around the world even hit their circuit breaker points, which means they actually halted trading until they kind of figured out they halt trading for 15, 20 minutes, things like that. The S&P 500 plunged, of course, and actually ended up trading in bear market territory, which means it was down 20% or more from its high. As of April 14th, the S&P 500 is down about 12% because there's been a bit of a recovery. The Dow Jones about 10%, and the NASDAQ, which is more heavily impacted because it's filled with more tech companies that are highly sensitive to these trade tensions, is down about 17%. Panic set in, investors rush to sell stocks. You kind of sell first, ask questions later. This rapid decline is something that we've experienced, but it's quite rare. In perspective, those first few days following the tariffs announcements, that was one of the sharpest declines we've seen since the pandemic back in early 2020. That was the same as when the earth shut down, basically the whole world shut down. So these are pretty big impacts we're talking about. As quickly as these markets plunge, though, remember that the rebound can be just as dramatic. And when we saw the tariff reversals and the pause, the S&P 500 rallied 9.5% in just a single day, almost 10% in one day. That's a huge difference. It was the third biggest single day gain since 1950. So this bounce back kind of perfectly illustrates how sensitive markets are right now to tariff news. So what does this all tell us? The short-term volatility is gonna probably continue. History shows us that investors can't predict what's gonna be next, and emotions tend to set in, which was why we see these kind of dramatic swings back and forth. That same history, though, also teaches us another lesson, that the volatility, while it's uncomfortable for sure, it's typically temporary. A similar event like back in 2018 with the US-China trade war, markets did eventually settle down and deliver pretty significant gains to those who were able to remain disciplined, able to stick to their plan, and simply be patient over time. One thing that was more unusual about this drop, and is usually more of a secondary event news, was the move we saw in fixed income in bonds. It's become incredibly important for us to kind of follow these things, because in a typical market downturn, a stock market downturn, investors want to buy bonds, right? They want the safe investments. They don't want to be in these risky stocks. They want to buy the fixed income yield that will pay them consistently. What usually happens is that bond prices will rise in times like this. So when you have a balanced portfolio, you have stocks and you have bonds and other things. So when people are selling stocks, they usually buy bonds. So it's like an offset in your portfolio. What usually happens is it's like a crowded theater exit. Everyone wants to get to the door at once. Things get too crowded, and prices, in this case bond prices, usually surge due to that increased demand. But this time bonds were a little bit different. After Trump's tariff announcements, bond prices actually fell. They went the other way, which means that the yields, the fixed income, rose sharply. So the 30-year US Treasury bond, the yield actually spiked up to over 5%. This is a huge move for bonds. It's one of the largest weekly yield jumps we've seen since the early 1980s. So this volatility in the bond market, it might have had a role in convincing President Trump to pause some of the tariffs. He did say a public acknowledgement of the bond market, saying it became a little bit yippy. So bond investors are also nervous. So when we look at it, we say, okay, wait, stocks are down, bonds are supposed to go up. So why did bonds actually go down? Well, first is the inflation fears. When inflation rises, bond yields tend to also go up. They tend to be correlated. With tariffs are actually generally thought of as net inflationary. So if prices are rising across the economy, investors anticipate higher inflation. And because bonds, at least the type we're talking about, pay fixed interest rates, inflation makes those fixed interest payments less valuable in the future. So investors want to sell them. That might be a little bit confusing, but it's just one of those things that if there's higher inflation, you want to sell your bonds. So you want to, that's why the yield's going to go higher. Second, there's some concerns about the investor demand for fixed income, like these 30-year US Treasuries. And that's because major foreign buyers of them, think of China and Japan, maybe became a little less enthusiastic about buying up American debt. There's a lot of political tension around. There's there's one of the ways that they can kind of fight back maybe is to say, okay, I don't want to buy your debt. I don't want to give you all this money as a loan and let you keep them. So when there's fewer buyers, bond prices tend to drop. And then thirdly, the move might have been caused a little bit by what the Federal Reserve has been saying, specifically in that they don't want to take too much action right now. In past crises, the Federal Reserve, usually steps in to stabilize bond markets. But right now their hands are kind of tied because inflation's still running a little bit hot, and the Fed wants to control inflation as well. So that limits their ability to kind of intervene at a comfortable level. Investors, we've been accustomed to the Fed kind of playing the role of the safety net, and this time the safety net's not super clear if it's there. So investors are being a little bit more cautious and again, sell first, ask questions later. The higher bond yields have many real world implications. It means borrowing costs for everyone. Like if you're a home buyer and you want a mortgage, or if you're a company and you want to fund some of your long-term operations, it makes it more expensive. So this bond market reaction is it's concerning, and it might have made the Trump administration pressured to calm markets a little bit and back off of some of these tariffs, at least temporarily. With all this volatility and uncertainty, seems doom and gloom, and you're probably wondering, what happens next? For us, the short answer is that, we expect there's going to be more volatility like we've seen. Markets are still highly sensitive to any news about tariffs, any news about trade negotiations or government policy shifts. Volatility to the downside is one thing, but there's also volatility to the upside. So you kind of just have to have a gut check and stick to it. A lot of this recent market movement, both in stocks and bonds, has been driven by these rapid changes in expectations. Emotions don't settle down overnight. You're not going to feel bad today and then tomorrow be like, oh, I'm okay. It's going to linger a little bit. You're going to remember, you're going to have some PTSD, if you will, from the market movements we've seen. Looking forward, we're closely kind of monitoring a few things. First is the likelihood of a recession. So economists have generally raised their recession expectations across the board. Recent surveys show a roughly 45% chance of recession, nearly double from just a few months ago. And consumer confidence is also taking quite a hit. When consumers worry, they spend less. If you're worried about, your job, or you're worried about your business bringing in money, you're gonna take a look at the expenses you're spending and maybe not buy that extra TV, or maybe put off your housing improvements. Consumer spending is a huge part of the US economy. It's something like 2/3 of the economy. So that when the consumer sentiment drops, it's something to pay attention to, as economic growth often slows. Second thing we're monitoring quite closely is inflation trends. It's actually been a positive thing recently, which has been one of the biggest worries in the last few years, has actually cooled significantly. Core inflation recently fell below 3% for the first time in 4 years. That'll give some room to the Federal Reserve if they want to maybe lower rates and put a little backstop in the economy as well. And with that, that's the third thing we're really watching, is what the Federal Reserve is going to do to react to this. It's called the Fed put. If economic conditions do worsen, most investors kind of expect the Fed to step in and maybe reduce interest rates. It's not a sure thing. The Fed is still cautious. They've communicated that pretty clearly, as they want to keep inflation under control, and it's only recently kind of come under control. They don't want to re-trigger more inflation by cutting rates too quickly. The biggest point here about all of these things is that there's still going to be some uncertainties. So while there's some hope Feds will cut rates if things do worsen dramatically, there's no guarantee. So as investors, we got to stay cautious and prepared for more ups and downs, more volatilities. With all the turbulence, just have to say as well, the Wealthmore portfolios, the conservative, the balanced, the moderate, and the aggressive growth, they are structured to handle uncertain environments, but they're not immune by any ways. Our strategy is rooted in proper diversification. You've heard the saying, don't put all your eggs in one basket, and that's what diversification is. You want to spread your investments across various asset types, various sectors, so that no single event like these tariffs or bond market swings dramatically impact your entire portfolio. But again, to be crystal clear, diversification doesn't mean that we're completely avoiding volatility or downturns. You have to take on a certain level of volatility to have the long-term returns that you want. It's not a magic shield against things when they go sharply downward, like when markets go sharply downward. All portfolios are going to feel some pain, including ours. The key difference, of course, is how quickly and how effectively properly diversified portfolio can bounce back when conditions do stabilize. And historically, of course, investors who maintain their portfolios and don't make emotional decisions through similar periods of volatility, they usually see stronger recoveries and better longer-term outcomes. You don't want to buy high and sell low. You want to buy and keep buying and make sure that you are invested in accordance to your risk tolerance and your objectives to get the long-term returns that your financial plan needs. Our portfolios are built around this principle that we want to carefully manage risk based on what your risk tolerance is and your objectives are, and position your investments for the eventual recovery and growth. So just to quickly wrap up, in case you started to fall asleep, some key reminders: the tariffs and trade tensions are, they're going to cause ongoing uncertainty and volatility in both stocks and bonds and other sectors. The markets are below their recent highs, but in perspective, it's about 12% for the S&P, 10% for the Dow, and 17% for the Nasdaq. That's as of April 14th. This kind of pullback isn't unusual during periods of economic stress and can actually be healthy for a market so that it doesn't get overbought and too expensive. Pullbacks are normal in the market. It's something that every investor is going to experience at some point in their investing career. And the third main point is that bond markets, they did react unusually this time because of that inflation fears and the reduced foreign investment and maybe the limited Federal Reserve actions. But it's something that we're just going to have to watch and stick to our plan with. Moving forward, there's going to be probably more volatility and recession risks are rising. Inflation is easing a little bit, which is good. So that should give the Fed a bit more options. And then just finally remember that the strength of diversification, our Wealthmore portfolios they're thoughtfully designed to manage volatility and recover strongly when the market rebounds. I know times like these feel like very unsettling. The market news it's not designed to make you feel comfortable in these points. And if you look back at some of the news cycles during previous market downturns, you'll see the same thing. There's never a good time to buy. The market's always going to be going down. It's always the next huge catastrophic event. But remember that doesn't mean that's how markets work. If you look long term, if you zoom out, even during the worst economic times and things that are happening, the markets tend to recover over time. So remember that volatility is temporary and market history does favor those who stick with their plan. So if you have any questions, just reach out anytime. Thanks so much for watching today. Stay informed, stay patient, and I'll talk to you again soon.